today for Annabelle Pacheco's weekly multifamily investing podcast. We do this every Wednesday at 2 p.m. Pacific time as well, and then it's 5 p.m. Eastern time and so on. It's also live streamed and then recorded on various social media, YouTube, Facebook, and such. And Annabelle started this a couple years ago, kind of chronicling her path as she grows in her investments in real estate, her first multifamily in the flip, and she describes that. And we continue to do that to this day. And she interviews successful investors, coaches, and vendors. And in this case, we're really excited to have kind of a past friend of ours who is a critical piece of the puzzle. Unless you have all the money to pay cash, most of us at some point need to get a lender in order to help us finance the deal. And a good lender will help us make or break the deal. So I'm really excited to invite back to our world Gina Koenen from Probate Bank. Hey, Gina, how you doing?
Hey, Bill, I'm doing well.
So I know we had you on my podcast 6 or 8 months ago, but I'm really glad to have you back. Just give a little background though. Where'd you grow up, and then how did you get into banking?
Well, I grew up in the Inland Empire in Canyon Lake, to be specific. And ironically, I accidentally ended up in lending. I started in the Air Force right out of high school, and my path was to be a nurse. And then when my son was born, I was looking for different ways to kind of be hybrid at home and in the office, and ended up meeting, now 15 years later, the boss that I still have, kind of loyal, and followed him around. And now I've been in the industry long enough. I understand how things work. And so, and ironically, I'm back in Canyon Lake. I just moved back here a couple months ago. So it's kind of neat how life circles back around, isn't it?
Canyon Lake, home of the pontoon boats.
Yes, that is correct. 21 foot long. That's the max.
Don't violate the rules.
No.
Don't violate the HO rules in Canyon Lake. Yeah. By chance, do you know a Dave Brittingham, longtime friend of mine? I haven't seen him for a long time though.
You know, that last name, I feel like I've seen that, but I do not know him. I just maybe in crossing.
Older than me, and I'm really old. Okay, so we've got somebody who's playing around. We'll give them one chance. Okay, so excuse me. So you got into lending, and in specifics at Provident Bank, which does a lot of different things, you do specifically lending in commercial loans, and I think the bulk of it is a multifamily, correct?
Yes, that's kind of our niche, our favorite product. We do lend on office units, light industrial, some self-storage. We actually lend on, on mobile home parks as well. But the multifamily it's kind of our niche. It's our box that we love the most. And so I can speak pretty freely on, at least from a lending perspective, from more of a prime lender rather than a soft money or hard money. Go ahead.
I would say one of my favorite things about you is once I know you, I can forever find your information easily, because your email signature line is most effective in the industry. You have all your information. I'm just going to share. If you click on the little bio link, it brings us up to Private Bank. It has your name, your phone number, your contact info, which is great. But in your email, you have a link to the commercial loan rates. And if you, of course, you have to have the password, you got to know Gina in order to get the password. And I also know what the rules about that are, but I have the password. All I do is click, and I have a loan rate. And I want to say, as a real estate agent, most of your career talking to lenders, asking for the rate sheet. And then on the rate sheet, of course, are different rules. But here, you've made it really simple for us. So I just want to say, on behalf of all of us who use your rate sheet and want to work with you, thank you for making it easy to do business.
Yeah, no, of course. And just to give you guys the access pass for the password, all you have to do is email me. And it's in my signature line, and I'll happily provide the password to the rate sheet. You're right. I mean, that's what we work on all day long. I'm looking at my competitors all the time, and it's very frustrating when you don't know a baseline of where rates are, especially when you're working with borrowers.
Yeah, and you make it really simple. And so our goal today was really to share, kind of what you do and how you do it, and kind of your program, because I think, for my money, your program is fairly, I don't want to minimize it, but fairly fundamental. Fairly, I won't say common, but you're a good gauge on where the market is. And I think, therefore, it's a great tool to educate people in the industry as for what are the common concerns, issues when you go looking for rates. And obviously, I think a lot of you, and I'm glad to recommend you. So let's go through the rate sheets a little bit, because I think that's a great tool to help us kind of learn a little bit about the multifamily business. So you have both a multifamily A program and a multifamily standard rate program.
Right.
Remember, last time we talked, the difference was fairly slight. The market, of course, changes from time to time. How would you describe the difference between the two programs?
Well, in a healthy market, and when rates level back to, what the investors feel is fairly healthy, I think we're working towards that. You should see a larger swing between the multifamily A pricing as opposed to the standard. And the difference in that comes down to the property itself. For a property to qualify for A pricing, we're looking for low maintenance properties that are clean and under 20 years old, maybe 30 years if they're in pristine condition or in a high employment area. So it really comes down to the level of risk on the property. So the A pricing today, I think when we spoke 7 months ago, it was identical. Today, we're starting to see that shift where A pricing is slightly better than the standard pricing. Probably 97% of everything I quote falls in the standard pricing, at least in this particular market. But there are those newer townhomes that have just been built, or the apartment buildings that are clean and built in the last 10 to 20 years, and those would qualify. And again, that's on the presupposition that the borrower's credit is strong and everything else lines up in the deal, right?
And I think also one thing that's surprising, I think people should notice, is that the rates have not gone up since we spoke last much. And that's because I think your business tracks more closely to a 5-year note than a 30-year fixed rate mortgage. 30-year fixed rate mortgage has gone from 2.75 maybe to 5.5%. The 5-year adjustment has gone from 1.75 to 3.5%, not as much. And so likewise, your rates have not jumped up as much a percentage as 30-year fixed rate mortgages have, right?
You're exactly correct. And my ear isn't to the ground as much on the single family products, just because I don't navigate that daily, but you're absolutely correct. And the jump that we've seen from last fall till now, for the poor borrowers that were right in the middle of their loans when we saw these rate hikes that kept happening 2-3 weeks in a row, that was unfortunate. But when you're looking at the net result between last fall and now, it's not as much as we were anticipating yet. Obviously, if I could predict the rest of the year, I'd be a millionaire, right?
Right. So I think that everybody, when they saw rates jump up so much, assumed that rate would continue up. And so far, it's kind of hit the high of 5.5 a couple of times, but hasn't gone through that. So we'll see where we are.
Is that where they are on single family in that mid fives?
Yeah, the best source I use is mortgage rates, and they're at 5.49. Came down from 5.5 yesterday to 5.49. So that's really this is the real market rate. Often reported in the news is the average of the loans they locked in and closed, but that date is already weeks old. But this is for new mortgages, you're going to get 5.49 today. At least the lender's going to get that, and you'll end up at that same spot if you lock and close at that. So
this is a unique market to see single family higher than apartments. I don't know that I've seen that in my career.
Well, again, it's because the single family is based on a 30-year, which is longer rate, and your rates with the penalty more track a 5-year note, and so that's gone up quite a bit. But I think that's fairly normal. Yeah, it should be somewhat less, but it's a little more dramatic right now than it has been in a while. So your loan program, your standard program, goes up to 75% loan to value. Of course, there's some restrictions to that, and most. So I would imagine, because of those restrictions, and we'll get to the debt coverage in detail, I would imagine most of your loan that you close are probably at 70% or 65%. Is that right?
You're exactly right. And the reason for that, and I love to educate, especially my investment brokers that come to me on the difference, because I'm one of the unique people in the industry that I love to work with single family brokers. And when you cross over and you're working with something you haven't worked with before, the numbers may not always be something you're familiar with. And on commercial, it's not just the loan to value that limits the loan, but especially in this market, the debt cover can push the loan to value. And so some brokers will say, well, how come you say 75% loan to value, but you're really offering 65, 68%? And that comes down to the debt coverage ratio. As you can see on the screen, ours is 1.2. That basically says that the property's net operating income needs to be at least 20% higher than new annual mortgage payments. So therefore, if the tenants that are selling the property, or if you're if you've owned the property for 5 or 10 years and you haven't raised those rents, those below market rents are what we're using, if they're in place,
Right.
to calculate our net operating income. And so maybe the sales value is there, but the net operating income value isn't there to get to 75%. Does that make sense?
And so most commonly investors will look at your loan and say, okay, we're going to buy the property. We're going to put some money into the property, $500,000 to fixing it up, to get to raise the rents, to get new tenants in, to get the tenants there to pay the market price. And then we'll come back and refinance. Now that we have the higher income, we can push the loan to value a little bit because our rents are going to be better. But you're right. So often I have people say, well, yeah, but the rents are artificially low. But the bank has to make the payment with what you have. That's all they have to lend on, right?
Absolutely. And the theory is, if market rent was truly, for it to be viable, it has to be in place. Right. So it's one thing to say that we could, in theory, get it, but unless tenants are willing to actually pay it, it's more of an illusion, I suppose.
Or want, or hope for. So up to 75% loan to value. Excuse me. But again, there's some other restrictions we'll get to a bit. Loan amounts $500,000 to $6 million. You go lower than that by paying some additional costs, which I guess you kind of have to do that to create some diversity in your portfolio. But this is telling us really where you are as a bank. And then if I said, what's your most common price, or what's your average loan amount? What's the most common average loan amount for you?
It seems like that $750,000 to $1.2 million range, because we're one of the few lenders, at least of our size, that will lend below $500,000. We do see a significant amount of loans around $400,000 and $450,000, just because there's not a lot of homes for the smaller loans.
And this is 5 units and up we're talking about?
5 units and up. We are also unique because we have a residential division as well. We're able to lend on 1 to 4 units as long as the vesting is to an LLC. So that's also a unique niche, because there's restrictions, as I understand, on the single family side, where people can only own a number of properties before they max out, correct?
Right, exactly. For Fannie Mae and Freddie Mac loans, absolutely. So you have different loan programs, and these are loans that are adjustable, where the loan is written for a 30-year term. This is the term, how long the loan is. But the rate's fixed for 1, 3, 5, or 7 years. And so what happens is the loan's fixed for a period of time, and then it resets based on a formula. And so I'm going to just walk through this because I kind of know the audience a little bit. The formula is going to be the index plus the margin. So the index is the 1-year treasury note.
Constant money market. Yep.
Constant money market treasury. So it's a 1-year, we would call the 1-year note issued by the US government. So do you know what the current value on that is today?
I do not, but let me look. Oh, I'm in my Zoom here. I feel like it was 0.5% the last time I checked.
Yeah, it's below 1 for sure.
But I've lost. Oh,
okay. So let's say it's a half. So if that's the case, the value is a half plus the margin, depending on which program you're on, be 295, 3125. So you have a half plus 295. So in this case, if you have a 1-year adjustable loan, and it could be for 4.1% up to 4.5, depending on what pricing you select. And then in the second year, it will go to the index at that time, today about 0.5%, plus 2.95, or in essence 3.45. So you can see this loan, the current fully index is below. Now here, 0.5% plus 3.125 would be 3.625. Again, still below. So the fully indexed, now you're taking the adjustable of the market on a annual basis. Are the limits to that adjustment at the first time, and are the limits to adjustment year to year?
You're correct. I do want to correct myself because it's been a while since I looked it up. The 1-year CMT is 2.06 today, which makes what you're explaining quite fun, because at the 3.125 margin, you're adding just about 2% over that. So if the rates were to adjust today, they actually would see an increase.
5.221, let's say.
Exactly.
Or 4.06. So, okay.
So at the end of the 5 years, what happens is the original shakeout is to market, whatever that is, to a ceiling of 6% over the start rate. And then every subsequent 6 months after that, the maximum the rate can go up is 1% at a time on up to the ceiling. So it would take 3 years to hit the ceiling at 1%, right? 6% over.
So this year starts as your floor, And then at the
Correct.
1-year adjustment, you pay the margin, the index plus the margin. So in this case, about 5.1 or 5.05%,
Sure.
capped at 1% over your start rate each year. And the life cap would be 6% over whatever your start rate is.
Correct. Twice a year, every 6 months.
Every 6 months. Okay. It's a 1-year index, but it's a 6-month adjustment period.
Yes.
Got it. Okay, good. Glad we're working all that out. So you have a choice for each of these programs. You have 4 different choices, and then within the choices, you have 3. And the difference is you have a higher rate and lower points. So how does that work?
Well, most people, most borrowers and brokers, and I work with both, probably 80% of my deals are wholesale to par to the broker. And if it's to a broker, if it's wholesale, I typically quote par, and then it gives the broker room to charge their point or their point plus processing on the front. Some brokers, depending on the deal, the complexity, things with the situation, there's room in the rate to add a half point on the back that also goes to the broker. So that would be that 4.45.
Got it.
4.1, the 1 point buy down rate, essentially for a whole point to buy down 10 basis points. Honestly, as long as I've been with Probate, I've never seen anybody go with that option, but we put it out there because our competition offers it as well.
Right. I mean, theoretically, if rates went straight up, you're going to save yourself that money over, a 30-year period or 10-year period. But the likelihood that's so low that you'd make a fortune on it. It's like selling insurance, they don't really need, but if they want it and they want to pay for it, I guess you sell it to them, right?
Exactly.
So most brokers, you say, charge par, some charge the half point rebate price. That means that they get back, they can either charge less to the customer or they can put that money in their pocket as a broker fee, depending on how they negotiate that with the client. And so a 30-year term, it's an index, it's the 1 year, but adjusts every 6 months. And then these are margins that create the new rate. So DCR, debt coverage ratio. So I'm going to let you now take over, explain. You mentioned it briefly. It really is the full income, net after all expenses, the way you calculate it, the income received divided by the payment, and the income should be at least 20% more. Is that a short version of it?
Exactly. And if you can help me out a little bit, Bill, what is the experience level of our audience? Because I certainly don't want to insult someone by talking too basic, but I don't want to talk over.
Well, I'd say it varies, and let's start from the beginner. I think really my goal here was to be an instructional video for the beginner and those who are experienced. I've done some. It's always good to refresh on the fundamentals.
Okay.
So from the very beginning.
Well, this is near and dear to my heart. I mean, as we talked earlier in the program this morning, I came in from nursing. I didn't even understand really what a deposit account was when I came into banking. So my niche over the years has grown into someone who was patient enough to teach me. So now I spend a lot of time actually teaching on debt coverage ratio because, as we've talked about, it really drives the loan amount that the property supports. So I do have a worksheet, and I can provide that link afterwards, that really allows us, because as busy adults, we're experts in what we know, and we just want the quick knowledge to what we don't know, right? So we can answer our customers. So the worksheet basically allows you to plug in monthly rental income, and when you tab out, it'll take you all the way through auto calculating all the way down to what the debt coverage ratio is, and then you just back down the loan amount till you hit the minimum 1.2. So essentially, a debt coverage ratio, the DCR, debt coverage ratio, states that the net operating income has to be 20% higher than the new annual mortgage payments. And the biggest variable that we cannot know until we see the appraisal is what is the true net operating income? Because we can use today's rents. Obviously, we usually know what that number is. But the moving target is a landlord that runs their property skinny. Let's say they do all the landscaping and they really cut corners in all the ways because they have the time to do so. Their operating expenses are probably going to run around 28%. And when I say operating expenses, I'm including landscaping, the additional utilities, taxes, insurance, everything that encompasses managing that property. Well, a landlord that owns the property, they have the time to spend to navigate all of those things and cut corners. But if the bank gets the property back, we have to look at market expenses. What's it going to cost the bank to maintain this property if borrower goes into default until we can move it on? And that number we won't know until we get the appraisal. So at early stages, when I'm quoting a deal, I try to educate the borrowers, look, I have to have a rule of thumb. I have to try to predict what the expenses are going to be at appraisal. So at the beginning, I'll use 35% of gross rents as a rule of thumb. On newer properties, it can be a little lower, like 33%. And then you've got the 50, 60, 70-year-old properties in LA. Sometimes those can push 38 to 42% expensive.
Easily.
But you have to kind of have an educated guess. And rule of thumb for me is 35% expenses, unless the Schedule E shows higher.
Right.
And then at least everybody that's in line with Provident Bank as my competition, we're using 5% as a what if vacancy factor, basically.
Right.
So those numbers, that 35% off gross rents, the 5% off gross rents, that gives us our net operating income. And then really what you want to do is run the ratio between net operating income and your new annual mortgage payments at the rate that I quote, or the rate that, we're offering over 30 years. And those numbers just, the NOI has to be 20% higher. And as we talked about, if the owner hasn't raised rents in a while, they're going to be lower than market. But like we just discussed, banks aren't going to honor the market rents. It's going to be the lesser of market or in place.
Particularly in Los Angeles, where it's not so easy to get new tenants into place, right? It's one thing if you could just like in Houston, Texas, give 30 days notice and replace them. But here in LA, you may not ever get the people out. And the other thing I think you said that I've seen is owners will say, oh yeah, my expenses are really low, because everything's run down and ready to fall apart. They have no capital expense budget. So yeah, the expenses have been low because you've been running your HVAC system and air conditioning, to the max, and it's overdue for replacement. The roof's overdue for replacement. It needs to be painted. It needs to be this. If you've done all that and spread out those expenses over time, your ratios would be higher. And so that's why sometimes the broker provided numbers. You need to take a look at the industry market, and that's what I think Gina does a good job, is giving you both the format and the standard numbers to look at a deal, and a way to look at it that will help you make a good assessment as an investor as well. They're like another set of eyes. I think it was interesting when I went to Grant Cardone's multifamily conference last year, the way he looked at the bank as almost his partner. Like, so often as a realtor, we're going to argue with the bank because we want them to be more aggressive. As an investor, it's almost like you want to say, well, if the bank will lend on it, why should I? Like, they're smarter than me. They got more money on the deal than I do. They can only lose money. They can't make as much as I can. And so I think we have to really use the opportunity to learn.
Yeah. And that is a huge benefit to taking the time to educate the broker, being the liaison between the borrower, because sometimes they'll say, oh, I'm going to go somewhere else. And a month later, they'll come back and explain that, okay, that is the highest loan amount we could get, but they had to learn for themselves and educate the borrower. Not all brokers, but some that are crossing over that don't know the terminology yet.
I know we're getting a little deep in the weeds here, but if you have, it's meant to be participative. So you have questions, feel free to raise your hand or put in the chat box a question, or just put a Q there, and I'll circle back to you, because we are, I think, going a little deeper than maybe we might normal as far as some details. So to go back to your rate sheet now, we know the DCR is 1.2 on all your standard product. Your maximum loan to value is 75 on a purchase or a rate and term refinance, but cash out, you go 70%. So this is a common experience where people buy a property, fix it up, raise the rents. When they put cash back in their pocket, that's limited to 70%, not 75 at your bank. And I guess, on your standard product and your A product. So fairly standard. And then you have a prepayment penalty. Now explain that. You have 321, 54321. Explain to us how the prepayment penalty is structured.
Well, this is another unique difference between single family and commercial investment properties, because in single family, your mind is instantly, I do not want to prepay. I want all the flexibility I can have with that loan. And even if I'm going to sit in it for 30 years, I still don't want to prepay, right?
Right.
On commercial, to get the best rate with the most competitive lenders, you're going to always see some sort of a prepayment penalty tied to the fixed period.
Yeah.
The most common, and the one I recommend always, because there's two, there's the declining prepay, and then there's that yield maintenance. And I'm not even going to begin to understand or explain the animal of yield maintenance. I know, in one market, it can be extremely expensive to buy out the yield maintenance prepay. And in other markets, it's a benefit, and there's a whole formula in understanding those. But what you'll see, and what you see on our rate sheet, is the standard step down. It's 54321 on the 5-year, which basically says if the borrower pays off the loan in the first year, they're going to pay 5% penalty to the principal balance, 4% the second year, 3% on down to the last year. And when the fifth year is over, then most borrowers can pay it down. They can refinance, pull some cash out. You really, to get the best rate, you don't want to do anything in that fixed period, because then you're paying a penalty, and then the good rate isn't worth it. And there are lenders out there that will do maybe a 3-2-1 prepay on a 5-year fixed. And that is a benefit, but again, we're not direct competition. Like Chase and I refer back and forth, Union Bank and I refer back and forth. Every deal is slightly different. When you're doing a 3-2-1 prepay, you're probably going to see a slightly higher rate. I mean, we're all trying to get the same return on the money within a few dollars. And it is a matter of understanding apples to apples between competing banks.
Right. And so it's just a trade-off. And I think this is why typically when you set up an investment like this, if you buy the property, you fix it up, you refinance into a 5-year loan, you kind of have a 5-year horizon. In year 4.5, you guys start thinking about that loan. You have your finances together. Do you have the paperwork together? Are you ready? You have a bank application ready to put together. You can close this right after the 5 years is over with no penalty, but you don't want to start then that 5-year period, because then you might find there's something that takes longer that you have to fix. So there's a prepayment penalty. And again, you have a 1, 3, 5, and 7-year product, each of which have 3 different pricing options. All your product is based on the 1-year Treasury bill, which is adjusted in 6 months with various margins. They all have a 1.2 DCR, and then the various loan to values and prepayment penalties. What percentage of your business is, let's say, your standard program versus the A program?
I would venture to guess probably 95, 97%
There you
falls
go.
in standard. And it's because of where we live. Most of the properties are older.
And so, my rule, even though they have it in the rate sheet, and so here you have the actual practitioner who does this, she's just telling you, just look at this. If this doesn't work for you, go somewhere else, because this is really what they're going to do. Unless you're a client of the bank, maybe you're in love with them, you love Gina, you might want to try additionally some of the product, but these are really more for other people or other departments, other areas. But the standalone is where you're going to make your money and do well with Gina, right? Is that a fair assessment?
That is extremely fair. Now, the one caveat of working with we're basically a big small bank where decisions are made locally. If I'm competing over 5 basis points, sometimes people will bring it to me and show me the competitor's rate, and I can go down the hall. We call it go down the hall. I'll talk with loan committee, and we can make exceptions. But again, it always comes down to the right borrower, the right property, and the right loan structure, correct?
I used to work for a smaller bank, actually. And I remember, so my boss was the manager of residential lending. And he said, well, I'm going to take this to loan committee. And I said, well, I was just curious. Who's loan committee? He says, well, it's me.
I'm not much of a stretch outside of that. We have a couple people, but yeah. I get
we work for a small company, a big initiative of Titans. We work for a small company. You're used to, and most people, I think, in your business have worked at Bank of America's or Wells Fargo's or Chase's or compete with them or know people. So you're used to talking about things using the terms that they use. But it's funny, you say loan committee and it's just some guy down the hallway.
It really is.
Okay, so we talked technically again. Any questions, feel free to raise your hands in the chat box, in the interaction box in Zoom, or put a note in the chat box. I have the muting disabled because we had somebody come in. But I'll allow you to unmute yourself. If you have a question, just jump in the meantime. So Gina, so we had a chance to go through the product. Thank you really very much for that. And we'll put into the notes your contact information. So if they want to reach out to you, they can reach you. And I'll put it here in the chat box right now as well. Let's talk more about the business side, because you've been really you've been successful at this for a long time. I think that, and I know you'll be very modest if I say this, but the truth is, you've been successful. You've worked for a company that's done this consistently over the years, good and bad. What do you see as the key thing that helps people make transitions, maybe from residential to getting into multifamily, or just starting out and having success in the multifamily space? What are 1 or 2 of the key characteristics you see that help them be successful?
Well, that's a really great question. I'm glad you asked it on a forum where we can talk about it here openly. The biggest thing that I see, and I say this delicately, but on the single family side, there's extremely successful people that have done very, very well. And the biggest disconnect that I see is the additional patience to not only learn how commercial is different, but transfer that information onto the borrower. Because it's so easy, like I said earlier, where a broker will come to me and say, oh, well, I want 75%. And they don't read if you've ever sent me an email, I'm pretty comprehensive on why it works, why it doesn't work, here's the rate. That way they can take the email and forward it on to the borrower. And I do find there are some impatient brokers that might not read those details. And it's disappointing only because I know that data is not getting onto the actual investor. So what I try to explain to the brokers that'll give me the time is, if it's new to you, trust that I've at least done this long enough, I can explain enough that the borrower can ask questions, right? And when I take the time to write it out, at least take the time to try and learn and educate the borrower, or do a conference call with me. The more we're all educated on something we don't fully understand, then, we're more productive all the way around. The next thing is, a lot of brokers will constantly ask me, how do I get out there and market? And isn't that, the wild card that we all want to know when we're in sales? How do I get more business? It can be difficult. You can go to title companies and sometimes they'll share a farm report. And what you're looking for, kind of the biggest thing, especially if you're coming from single family. In fact, I got ahead of myself with the title report. Go to your contact database, because more than likely you're going to have investors that own 2 to 3 units or 4 units. They most likely own 5 to 7 units. It really is a simple crossover. What investors do you have that are aggressively trying to grow, and now they've hit the limit of how many properties they can own on the single family side? Again, we'll lend to an LLC. So that bridges that gap and then helps that borrower kind of understand investment lending and cross over into that 5, 6, and 7 units. So the best place to start is in your own contact database and see who owns what you can recall and recreate within your contacts. Secondarily, going to a title company and getting a farm report. Quite honestly, even after, I'm trying to think, I got into this industry in 2003. I do not want to do the math because I just realized that number's a lot higher than 15 years. But nonetheless, I still, even after all the years I've been doing it, quite humbly, I'll go out to Google and I'll start looking for, investment brokers and try to meet people that way. I'll send them individual emails. I mean, back in the day when, before COVID, I'd go knock on doors with little bags of cookies. I mean, it really, because the only thing I have to sell, I can sell products anywhere, but it's myself. It's the knowledge that I'm willing to share and how to educate so we all move forward. And so meeting people in person is the best way to get the quality relationships, and getting those customers to come back to you.
So towards that, 2 things. I love the first one you said, because I say this all the time. My particular niche is probate real estate. And so I'll get agents will say, well, what's the best way to break into probate real estate? And I'll say the same thing, which is the people who know, like, and trust you. If you've been in business for a while and you're making money, but you want to do more, you want to double your business or whatever, start with who you know. They already know, like, and trust you. You have to find among those who know somebody who has some probate business. That's easier than calling people a probate business and getting them to know, like, and trust you. That's a different business entirely.
I said that if you.
Okay, I'm going to take mute himself away. So 100%. I agree with you. That's the obvious. I've personally in the last year, I listed a industrial building. We had an escrow fill up, but we're going to resell that. I have a retail property that's in escrow. I'm taking a listing tomorrow on another retail property. I'd never done it before. These were all referred by people who know, liked, and trusted me. And I started digging deeper, felt more comfortable in the commercial space, and I was able to make that crossover in my business. So you're 100% right. That's fantastic. Number 2, I will say, for anybody on this call that wants to, if you're in the LA area and you want to meet people or learn about the business, there's a real estate investor expo at the LA County Real Estate Investors Association. That's tomorrow, Thursday. It's the second Thursday of the month in Culver City on Motor Avenue. There's the details, and you can text or email me for the details. But it's a great place to meet new people. But like Gina said, number 1, I didn't prompt her on this, which is start with who you know already and find out who amongst that group either wants, and that's what Annabelle did, who wants to buy or sell multifamily properties, and then reach out to them. And introduce them to people like Gina so that they'll feel comfortable and take that next step. So let's talk about, that's for the real estate agent. Let's talk about the individual investor. What do you see as the common characteristic of and I'm sure you talk to a lot of people who want to invest in real estate and never do, 90%, 95%, versus the 5% actually write a check and get started. What do you see as the difference between those two?
Well, crossing over really isn't a whole lot different between the investor and the broker, because from my seat where I stand, it really is educating and helping the investor understand what to look at. And so a lot of times it's as simple as an investor will call me and say, I'm looking for a property. And I'll say, okay, start hitting the MLS, start talking to whoever to find what you're looking for, and then put it in my desk so I can tell you and run the numbers and figure out, what loan amount is supported.
Right.
And sometimes it's a couple-month process. They're constantly sending stuff at me, and then they start to go, oh, okay, now I understand from, just eyesight, this will work, this won't work. They get a feel for it. So it's constantly educating, right? And of course, you have to have a borrower that has money for the down payment, or they can't be playing in this field, right? It's not 10% down, or the differences on the single family side. I mean, because we're looking at 30 to 35% down, we have to make sure they're shopping within the right ballpark, and then managing those properties very well. Well, there's two things now that you're bringing this up. These are key that I see as a big hurdle most of the time for investors. One, there's a lot of investors out there that are fantastic landlords. And then there's a lot of investors that just want the money and don't really care as much about the property. And you alluded to this a little bit ago, Bill, where unfortunately landlords will let properties get run down. They won't upgrade, old cracking tiles and water leaks in the ceiling and the HVAC. And as a lender, we're running a pretty comprehensive appraisal in order to look at this property. And when we're seeing a lot of deferred maintenance, we'll either hit the brakes completely or do a holdback and force the borrower, in order to proceed with the refinance, they have to cure these cosmetic issues. And so my best advice on that is, if you are a property owner, make sure it's fair and clean for people to live in. The next hurdle that I come across a lot is—
You say that so casual. You say it so casually. Make sure it's clean for people to live in. Okay, no, I'm because sometimes they think they don't have to, and you're right to say that, but we have to remember these are human beings who are going to be renting. They're going to be your customers living in the property. So I'm sorry, go ahead.
Well, no, I love that you paused me on that to take a little bit of time, because unfortunately in some of those more rural areas where the properties are older, it kind of is everybody's lower here, or the condition of all the buildings in this side of town are kind of run down, so I'm going to let mine be run down too. But it doesn't take much to slap a coat of paint on and really, put low end carpet and keep it clean so that it's safe for people to live in. And it's rare, but I do come across where I'm just looking at the owner going, wow, how could you let this go? Especially when you see how much equity and how much they're earning on it. And it's unfortunate. The other thing that I do see is there are those, there's a small percent of property owners that are fortunate enough to take in cash for rent, which is great, especially if you're a small business owner. I mean, either way, you're either going to tell Uncle Sam all if it's all electronic, or sometimes we like to put a little cash in our back pocket. But the catch with that is you can't get the best of both worlds. You can't avoid tax liability and get the loan that you're seeking if we can't see what you've reported to Uncle Sam is the true rental income that you're bringing in. And so my best advice, I understand both sides of that coin. Having owned a business, I get that, but don't be frustrated when you can't get the loan that you're seeking because you're not reporting all the rental income the property generates. And that's a big deal.
And don't generate a second set of tax returns.
No.
I've seen that trick. There was a time that worked up until like 1990, I think, but now, there are customers who just insist, oh yeah, no, this will work. No, it worked last time you bought it, but it doesn't really, we don't do business like that anymore. And people go to prison. I've literally visited people in prison who did something like that. So you can't do that at all. Yeah, not good. So
that's why tax transcripts came about, right? Because
exactly why.
To deal without them now.
Right. It used to be a very rare thing. If you had some probable cause reason, an underwriter requested, it cost money, it took some time to get it. Now I think every file that we double check tax returns because we can look on my own taxes. I made a mistake, and it was easier to go online and get a returned copy than it was to, I don't know, go back, find the copy or whatever I had to do. So let's talk about COVID and the issue of tenants paying rent or not paying rent. I think it's worse in Los Angeles overall, and you're more Inland Empire based. So let's say outside of Los Angeles, I know I heard a statistic in LA that 10% of tenants haven't paid rent in 2 years or more, relying on various programs or not. Do you see that same kind of percentage outside of Los Angeles? And do you see that changing at all?
I do. Actually, in the last year, in fact, we're seeing a lot more cash out refinance requests simply because of the healing that's happened since 2020 and 2021. We are we're on the heels more of that than we were this time last year, which is a plus.
Right. Outside of Los Angeles.
All areas, you are correct. The majority of it's in LA, but I've got a couple properties in San Diego in the last couple of months that also had, I think across the state, because I'm fortunate we do lend in the whole state. I'm seeing it in, some of it happened in like Modesto, Sacramento areas, San Diego, kind of all over. I mean, everybody really was affected. Right. You are correct. It is a little more difficult for landlords to evict tenants in LA than other areas. And so that can stem a little bit longer. Yeah. But we're starting to see the healing of that. The big caveat there, and it's tough because these borrowers have been waiting a long time for these tenants to start paying rent. So now they can refinance and do the property upgrades. But we do have to lean on the borrower to have strength financially to offset the probable or likely risk that COVID could do this to us again. Right. So now we're not only saying, oh, we understand you didn't collect the rents for this time period, but instead of 6 months reserves, now we want 9 months reserves to mitigate for the probable risk or possible that it could happen again. So we're kind of saying, we know it was tight, but we're going to make it tighter for, and that's just to mitigate the risk. So those are differences that we are seeing now. Although with the market healing, I have a feeling reserves may change this time next year. It's hard to.
But I think that's why it speaks to why we're not likely to see a repeat of 2008 and 9 is the banks and the lending system is so much more conservative than it was last time when we have these breaks in place. On one hand, you have landlords who cry the blues, properly they're not getting paid rent. On the flip side, their properties went up in value 15, 20% a year. So they came up better than if the people had paid rent in a normal year. And so I think overall, we've seen the healing process come pretty quickly, but it's still, there's some disruptions in the marketplace. So what do you see overall his values? I do a weekly real estate report in the residential side. And I think, for so long, there's been predictions of a housing market bubble, crash. There might be a recession, in the economy. Doesn't seem like it's affecting real estate, at least home values. What do you see as far as multifamily?
It's hard to say. I mean, as rents heal, as people are more comfortable being able to pay their rent because now they're back at work or the new hybrid of work at home state, people are, I guess what I'm trying to say is with the more remote options that are happening long-term, not just short-term for COVID, but a lot of companies are downsizing their brick and mortar on the office side, which unfortunately causes a whole other domino, correct? Because with bigger companies downsizing, now office can be risky and retail is certainly a risky. In fact, I was impressed that you talked about, kind of going in and having some retail properties recently, because I'd love to know who those lenders are because retail can be risky. So that's bleeding over to that side, but with more people, again, it's giving more stability to the multifamily market that's always been strong anyway, but even stronger now with people working at home, needing a little more space, backing into the more rural areas rather than straight in LA because they have to commute every day. Right. Now they're more comfortable being on the outskirts of LA or even some are filling in the central coast of California because they can. I think it's giving strength to the rental market. It's giving strength to multifamily. And we are seeing an increase in sales price, even though market rents haven't quite, caught up as far as what people are willing to pay anyway.
But I think the key in retail is like multifamily, if there's cash flow, then you have security. And so where retail is booming is when there's a business that through the COVID period has done well and can financially afford a loan. They can get their own property and they can afford to finance it because of the cash flow and a record to support that. I think the days of buying property and renting out to somebody, triple net at least, those are challenging times because if there's nobody in the space today, who's to say there'll be anybody renting it next year? But if you're a business and you are moving your business into bigger facility because you're making money, there are banks that seem to be lined up to lend the money. At least that's my experience. So I was surprised, but it's pretty competitive. This client of mine had a loan lined up on the property, but he replaced it with a different bank because they were anxious. His commercial bank was replacing the retail loan they had. So,
okay, that's brilliant.
Yeah. Okay. So, last chance for questions, comments. You can raise your hand in the Zoom, or you can put a question in the chat box. But you really have an incredible resource. I could talk to her all day long. I feel like I've hogged up the call here, Gina. But I really enjoyed catching up with you again. It's been a little bit of a while, but I think you have such an interesting perspective on the market. You sit really at an important intersection. I know I'm not personally investing in multifamily in Southern California. I'm investing outside, but I think your perspective, you see the market and have been a great resource and taught me a lot. Anybody have any questions before we wrap up? Oh, how can we get the calculation sheet that you referred to? There's a good question.
Well, I would be happy to share the link. It's probably not possible that I have control of the screen, right?
You can put your link in the chat box, or I can share the screen if you want.
I'll share the link to it, but I really like to show people.
I'll share the screen with you. Go ahead and
how to use it. Just because they're going to pull it up and not.
Yeah, no problem.
So,
one participant, multiple participants, host only, all participants. You should be able to share the screen.
Oops, hold on. I went to the wrong website. Okay, so this is just a personal webpage. When I started with Probate and I started teaching, they were kind of confused on where to put my worksheet because it's not a bank product. It's something that I sort of developed just to teach myself and then later teach others. So it's actually out on my personal website. I literally have really nothing else there except some old slides from a webinar I did. I see that very outdated, 2018. The only link that matters here, can you see that okay, Bill?
No, I don't see anything.
Oh, how do I show it through the screen here?
Share button. You should be able to share.
I don't see. Oh, share screen. I see it now. Okay, so share.
There you go.
Oh, everybody sees that. So
there you go.
My website is, and I'll have Bill share it with everyone. It's gmvirtual.com, which is Gina Marie and the word virtual.com. And right up here at the top left, you'll see DCR loan amount worksheet. And let's see if it's still sharing when I open this. And it takes a few seconds when you see it. It's kind of fun. Can you see the Excel doc? No.
It downloads it immediately.
Okay, so new share. Let's see. Here we go. Okay, how about now? Are you seeing a worksheet on screen?
No, that's a spreadsheet of. That's weird. I think that's my sheet. I think somehow it's sharing my screen. That's really weird.
It's a spreadsheet.
Oh, I'm sorry. There you go. Yes, I'm sorry.
Okay, so the top of this spreadsheet, I've just designed for brokers to be able to show it to borrowers. And so you would put in the property address, the client name, date, etc. The meat and potatoes of this particular worksheet is, let's say that growth monthly rental income is 5,000. Is it going to let me type? No, I have to enable editing. Hold on just a moment. Okay, so if we, I canceled screen share. Hold on. Okay, should be back up now, right?
Yep.
Okay, so let's say that rents are 5,000 a month. When I put that into this line and I tab out, you'll see this whole form makes it so you don't have to think. So if you're on the phone with the borrower, at minimum, if you know what the rates today are, which are 4.25 on our 5-year fixed, at 6% cap rate's a little high. I would say in today's market, 5's a good rule of thumb. So really here is kind of what we're looking at. And all this form does is $5,000 a month by 12 months. It minuses out that rule of default or rule of thumb on 35% of gross rents for expenses right here in this line. It defaults to 5% for vacancy. Here's our net operating income estimated without seeing an appraisal at $5,000 a month income. Then at a 5% cap rate, this next line automatically tells us the NOI versus the cap rate at 5% has a value of $720,000. And just because I like to see it when I'm on the phone with a borrower, if the property's net rental income supported 75% loan to value, $540,000 is the supported loan amount at 75% loan to value. But then we come down here to the magic variable, and I see this all day long, every day. The property has 720 value at 75%. Everybody thinks the loan works, but at $5,000 a month, we're below our 1.2 debt coverage ratio that we need. So what this is saying is that this net operating income is only 13% higher than our new annual mortgage payments, which is right here at $31,878. So this is where the form makes our brains not have to work. We don't have to pull out a bunch of calculators. Really, all I'm going to do is play with the loan amount until I see my debt cover at 1.2. Oh, I guess I missed a 0. So we're getting closer. So maybe about 515. Oh, even got myself. There we go. So even though 75% loan to value is supported, the debt cover wasn't at our minimum. So this particular property at $5,000 a month, maximum loan amount supported based on the assumption that 35% holds true at appraisal for expenses. We're looking at 510 as a loan amount at a rate of 4.25, amortized over 30 years, and our monthly principal and interest is $2509. So if you guys want to save that spreadsheet, and then what I always tell my brokers, even if you're super comfortable with the numbers, just because I'm the lender and I'm the one that, ultimately understands if we can do the loan, before you get on the phone, because I hear it all the time, oh, I already told my borrower all about this. I quoted them and sorry, I didn't check with you. Can you hold true to the rate that I quoted them? And I said, well, kind of lean on the lender first. Let me double check your numbers. Let me make sure you've got the cap rate correct. So I always ask brokers, send me what you've run, send me the listing, send me the rent roll, whatever you have, so I can just back up the numbers before you call the borrower and kind of promise the whole boat. So there we go. Questions?
So there you have a copy to the link. You have an explanation here on this video. Question. We'll send you a link to replay the video. So if you want to watch or walk you through that again, you can. Can I show you a little trick, Gina?
Oh, I would love it. Yes.
So just using your sheet. So this is using Excel's solve for problem. So here's the problem you mentioned. 75% says 540, but at 540, our debt service coverage is too low. It's 1.13. So what I want to do is click on this thing and go to, in Excel, what if analysis goal seek.
Oh, I'm going to take notes, Bill. This is great.
It's recorded. We're recording the video. Goal seek. And so I'm going to set the value for this. This is a G28 to a value of, you said 1.2, by changing cell number G22. I just click on this one that we know is wrong. I hit OK. It calculates 508,278 exactly.
Are you kidding me?
It's called a solver. So it will solve that number. So rather than going back, now obviously you can go back and forth and estimate it, but this just gives you the actual number. The other thing
Bill, that's brilliant. You have no idea how many years I've been trying to figure this out. I did not know we've advanced to a solution to this.
Yeah, Excel is amazing. You can launch a rocket ship with Excel, and like you, I keep some data in it once in a while and move it around, but it's an amazingly powerful tool. So yeah, that's just called the data solver. And again, I recorded that, so if you guys want to go back and see it in time, you can look at that as well.
Yeah, I might go ahead and adjust the form and re-update it because it's probably been 8 years since I've updated that on there.
Well, these tools work. It's funny. I have the same thing. I have a very good friend of mine who has a headhunter business. He started it 25 years ago. And he called me that day and said, hey, I have to do an invoice to my client. Do you have an invoice form? I said, yeah, I have one. And it was a Word document. I sent it to him. And I saw him recently. He said, we just moved to invoicing through QuickBooks. Up until last year, we've been using a variation of your invoice form this whole time. So because it worked. I had customers who paid it, and it was like a good luck charm. You get used to using the same thing over and over again. So,
Yeah. Oh, I love that.
Okay, so I don't see any more questions because I think you really went through and explained everything so well. This is recorded, so if you want to watch it again, which I recommend, to go through the details on the explanation of the ratios or Gina's magic spreadsheet, how to do that, great. And also, if you want to get a rate sheet, email her and she'll be glad to send you the magic formula to get into her rate sheet. So I don't want to give it away. So look, on behalf of Annabelle and everybody here, Gina, thank you so much for your time today. Thank you so much for your time throughout your career, as short as it is, because you're young. You look like about 21 years old. So
yes, we'll go with that.
Hard to believe you've been around so long, but really, I just really appreciate your approach. I think like mine has always been to come from education and help people be successful, and then that will take care of you. So thank you for your time. I really appreciate it.
Yeah, well, I appreciate you having me. You're fun to collaborate with on these. Thank you.
Yeah, it's been great. And then last, just remind everybody that tomorrow night, if you're interested, if you're here in Southern California, we have Real Estate Vendor Expo. It's free. It's in Culver City at the Iman Center in Culver City. And there'll be about 250 people there. There'll be 50 vendors. There'll be some investors, and the people making the talk, good friend Deborah Razzo, and a couple other good friends who are the speakers, women making moves and money in real estate. I'm not a woman, but I support women. My wife's a woman, my daughter's a woman, so I'm all big on helping women be successful. So come tomorrow night, it's free. It starts at 6, but I will say parking lot fills up. So either get there early, Uber there, or park and walk aways. And I hope to, if you're there, I am looking forward to seeing you come up and say hi and introduce yourself. So again, on behalf of Annabelle, Gina, thank you so much, everybody. Thank you for being on the call today. And we'll do this again on Wednesday at 2:00 next week. Thanks so much.
Fantastic.